Well, the market is finishing up an ugly quarter and an ugly September, the worst September for the Dow since 2002 and 2008 for the S&P and the NASDAQ. We remember what was happening then. Joining us now for some top ideas for the next quarter is Wells Fargo Investment Institute's Scott Wren. And I'll just point out that we are now making session lows again. We've headed south and we're down more than 400 points, 438, falling fast here on a Friday afternoon for the Dow. The S&P 500 is now down 1.25%. Looks like it just took a spill here into the closing bell, Scott, down 2.7% for the week. So what are you telling your clients to do?
Well, Sarah, you know, what we've been trying to do really since early March and into April and into early May was get defensive. I mean, we're in hunker down mode here, and I think we're about as defensive as we want to get. I mean, we're sticking to from a larger picture perspective. We like large caps. We do like some mid caps. We want to be in very short term fixed income. You know, this is capital preservation mode, not capital appreciation mode. And so I think, you know, for the fourth quarter here, you know, do we think the market's going to be a little bit higher than where it is right now? We've got a 3,900 year-end target out there, so we do. If that happens, we'll probably see things like technology, healthcare, energy help get us up there. But we're not expecting a whole lot in the fourth quarter. And I think into the early part of next year, you know, hunkering down, capital preservation, that's what people need to think about. Hopefully, they're defensive by now. They've had plenty of time to do that. Now it's just riding through the volatility.
When I think of defensive, though, and this is a question for Nancy, too, who is recommending dividend growers, I think of the staples. But if you look at the 52-week low list today, Procter & Gamble, lows since March 2021. Mondelez is on there, McCormick, Colgate, Church & Dwight. These are supposed to be the safe places to go during recession, Scott.
Yeah, it's true. You know, it's tricky, Sarah. There's a lot of, you know, within, let's say, staples, you know, there's a lot of different cost variability because of inputs and things like that. And so I think you have to be, you know, you have to be very choosy here. And, you know, whether it's technology or consumer staples, you know, you need to pick companies that have good cash flows, that own their niche, that have good balance sheets, that have products that are selling and that they can supply and they aren't seeing their costs just absolutely soar. So, you know, you really have to put pen to paper right now. Well, I mean, you know, let's say in technology, which has obviously been hammered here, you know, you need to look at technology companies that are focused on efficiency, automation, those types of things. And then other staples, you know, you have to pick and choose where, you know, you might have a staple that has really high food input prices. Well, you know, they're probably not faring all that well, where you have something with some slightly less sensitive or tight supply type of inputs. Those are the ones you need to gravitate toward. But, you know, the bottom line is you want something that's less sensitive to the economy, isn't suffering from a bunch of input price pressures, and, you know, can still deliver at least some semi-adequate or good earnings growth going ahead.